This is my first class for performance management, November 2025 diet. I am Dr. President and I'll be your host all through performance management class, except if somebody comes to bench me. All right, so for performance management, we have a lot to cover. This is the updated syllabus as released by ICAN. And as usual, there's going to be linkage with other related courses. So for performance management, it is linked to SFM. So you will see some of PM inside of SFM. So just in case you think that if I escape PM, that is all. No, you meet few in SFM, just very few, anyways. Then you also meet in FM. So for those of you that are also doing FM, PM will assist you to think broader, okay? So you can be able to perform well. Then it is also linked to case study. Yes, when you're writing your case study exams at professional level, there are some places where you may be needed to do some computations, and those time in those areas, PM will actually suffice. Then it is also linked to MA, management accounting. For those of you that did foundation level MA or during your university time, you did MA, management accounting, or cost accounting, they are all linked to PM. You do not need textbooks for each of these linkage or each of these linked courses. All you need is the textbook for PM. All right. So I can pack is sufficient. Get your past question, join my class, do my assignments. There's no oracle that can stop you from passing. It's as simple as that. Do I need to go through the syllabus? I do not think so. Because I don't think there's any, there's just a very brief changes in the syllabus, which I don't want to dive into now, but every other thing remains the same. Okay, so the syllabus is broken down into the parts that relate to MI, Management Information System, and Data Analytics. So data analytics was introduced into PM just this diet. So that will take 10% of the total weight of performance management. So remember that we have MI, right? So in PM, we have the management information part of PM, which is theory. So they've also included data analytics. You'll be looking at Excel and some other things. If ICAN decides to go digital, you may be needed to use Excel to compute some of their calculations. Let's just hope they don't go that now. So the next one is going to be advanced costing technique, which is going to be 15%. Then we have decision-making technique, which is 25%. This is the boss of them all. It is quite very rare for ICANN to test a question per diet without releasing decision-making question. Just like last diet, May 2025, your number one question, I guess, was actually what do you call it? Relevant costing. That is under decision making. Last two diet, they brought it, and some students were thinking that since it came out last two diet, ICANN wouldn't bring it again last diet. They were shocked. Bim, ICANN released it for them again. Very hot, and they got it, and for those that read, they were able to pass. Then the other one is going to be budgeting and control. Okay, budgeting and control. This takes 20% of the syllabus and it's going to cover a lot of things. It's going to cover the cash budgeting, the operational budget, and the flexible budget. Last diet, I can do justice to flexible budget. They bought flexible budget, and that means that they may be switching to operational or cash budget this time. And the next one is going to be performance measurement, control, and management system, which is 15%. Then we have performance evaluation and corporate failure. Corporate failure. I don't think corporate failure has been in the syllabus. So this was newly introduced. The corporate failure introduced into the PM syllabus. That ranks about 10% of the syllabus. Then we have emerging issues in performance management, which is 5%. Added together gives us 100%. Now, what are we trying to talk about? It is very simple and easy to pass this course. And at the same time, it's also very easy to fail this course. Now, if you have been writing this course for one, two, three times, you should ask yourself what has actually gone wrong. The number one thing that may make you fail is your inability or inconsistency to be in class and solve questions. Sometimes you will solve questions, or sometimes you'll be in class, and after 1 hour of lecture, the devil is going to blow some kind of breeze, calm one to your face, to your ears, okay? Before you know, you begin to doze your destiny off, and that is one way you can fail. Then when result comes, I say, got 35, got 2, I got 12. Find a way to overcome it this diet. Second one is you don't want to bypass questions, thinking that you always use soft copy. Soft copy does not pay everybody. So bypass question. If you're inside the bus, hold your hard copy past question, but don't forget your bus stop. Start solving. Okay, start analyzing, start checking it out. The more you constantly look at those questions, the more the question begins to fall in love with you, and the more you begin to write and pass your exam. So please get past questions, attend classes, and do assignment. More importantly, do assignment. You may attend this class and say, this class is very interesting. I understand it. Let me give you one question to go and solve. You may not find it difficult. Why? Because you failed to practice after this class. I would always give assignments, okay? I can ask a lot of questions from their past question. I will always give assignments. Let the serious one that want to pass do my assignment and send the assignment on the platform. I would receive it. Okay, so I want to be going to in depth on what each of these categories entails. Everybody has the syllabus. Please go and do that at your leisure. But please note that my prediction for PM is already open and sure. But I can't give you the prediction now because lecture is just starting. If I give it to you, how will you still pass? There's no way. So understand the lectures. When we get to marathon, I will unleash my predictions, and by the mercies of God, you will all pass. Now, what are we starting up in today's class? My first topic in today's class would be Introduction to Performance Management. Sadly, I don't really have a material for that. Interestingly, I plan to take Introduction to Performance Management and also Marginal and Absorption Costing. But before I move into Marginal and Absorption Costing, I will spend just 10 to 15 minutes introducing this course to you and telling you the things that you need to know going forward. In performance management, ICAN is trying to examine your ability to evaluate the performance of an organization. Is an organization doing well or not? Is an organization going to survive or not? Is an organization increasing in profitability or not? From the word performance management, you are evaluating the performance of the organization, one. You are evaluating the performance of managers, which is management, two. You are evaluating the performance of a product, three. That is why sometimes you say prepare a profit statement. Yeah, profit statement for individual products. That means you're evaluating the performance of a product. It can also tell you to evaluate the performance of divisional performance management. So when you talk about performance management in totality, just what comes to your head is how you check the performance, how you appraise the performance of either the organization, the management, the product, even the projects. Okay, that's why you talk about project management. So everything that you are appraising, okay, comes under performance management. Under performance management, we're also talking about setting of prices, all right? How you set prices for products, how you determine the cost of running a department, cost of running your company, okay, how to determine the cost of making a product. All these things are all around performance management. But the beauty is that ICAN would never ask you what performance management is. So since ICAN will not ask you, it is better you just have an understanding of what performance management is so you are able to defend your certificate in the future. As we go forward again, I would also like to unleash that there are some terminologies in performance management that you need to be aware of. And please note, performance management was formerly known as management accounting, all right, before it was changed to performance management. And now it is now like the advance of the management accounting that you have at your foundation level. So many of you that passed through foundation level that did MI, that MI is now known as management accounting. So the advanced is now known as performance management. Now, what are those terminologies that you need to know in performance management to help you to solve questions going forward? You cannot solve questions going forward if you don't know these terminologies in performance management. Number one is cost. Performance management talks about cost. If you are trying to appraise the performance of a company or a product, you should know about the cost because when you're appraising them, you need to know how much was incurred, how much was generated. You need to know all those things. So cost is one terminology. So what is cost? Cost simply means the amount that you spend to acquire something. How much did you buy your iPhone 16? That is a cost. How much did you buy the generator in your company? That is a cost. How much did you buy your laptop? That is a cost. Whatever amount that you spend to acquire something is a cost. So I can tell you in the question, determine the cost of what? Product A, or determine the cost of product B. So when they tell you cost, it means how much was incurred, how much was spent to do it. There's no need for you to start coming about getting revenue. Talking about cost, there's nothing like revenue included in it. So please check your requirement and be assured that you have cost as the requirement. So you just focus on cost. So that is what cost actually means. Another thing you need to understand is that cost itself is broken down into direct cost and indirect costs. All right. So we have costs. Okay. So we have two. We have direct costs and we have indirect costs. Now, for the direct costs, I trying to talk about those costs that we incur because we have decided to make a product. It means that they must be compulsorily incurred in making the product. It's quite very simple. If I want to cook beans, I must buy beans. So that money I spend in buying beans is a direct cost. So because I have chosen to cook beans, that beans that I bought is a direct cost. I must buy crayfish, I must buy pepper, whatever I might buy in the game, sardine, whatever I want to buy, those things are the direct cost. The bottled water on your table or that you take at your place of work, if the company decides to produce bottled water, the plastic is the direct cost. The labeling is cost. The cup, that is that cover, it's a cost. The water inside is a cost. All right. So all these are direct costs. Why? Because they are directly incurred, okay, in making that product. That is direct cost. So once you understand that direct costs are those costs that you cannot escape whenever you decide to make a product, that makes you understand that we have direct material costs, it may relate to material, direct labor costs, and direct expenses. So these are the breakdown of a direct cost. So a cost can either be incurred on a material, known as direct material cost. A cost can be incurred for paying laborers, which we call direct labor cost. Then any other cost that does not fall under material and labor becomes direct expenses. All right. So when you see your question, you see direct material. So direct labor, direct expenses, those are amounts that we spend on material, labor, and expenses individually. And they are all direct costs. In performance management, all direct costs added together are known as prime costs. Okay. So call it prime costs. So just in case you see a requirement that says compute the prime costs of making this product, that should not be a problem. That simply means add up all the direct costs as one. That gives you your prime cost. It's as simple as that. Now we'll move to the next guy, which is the indirect costs. Now, indirect costs are those costs that we incur, okay, in making the product, but they are not directly related to the product. When we were making the bottled water, there was a woman that usually comes to clean the factory. That's an indirect cost. The fact is that whether she comes or not, guy, we will still produce. Bottled water will still be produced. But trust me, if we don't get plastic for the bottled water, there's no way we can produce bottled water. We will wait until the truck bringing the plastic would come. Okay? But when we don't have the person cleaning, we can just use our leg or use broom, pack the thing one side and continue our production. So the person that sweeps is an indirect cost. Okay, depreciation is an indirect cost. So any kind of cost that we incur, that by examination of that cost, it does not really lead or directly, it's not directly related to that product, constitutes indirect cost. The accountant's salary is an indirect cost. Okay. The manager's salary is an indirect cost, except where it can be proven that that manager is a supervisor that must be present before production takes place. That is the only way you can make him a direct cost. But every other salaries, gate man, all of them, they are all indirect costs. Now, the fact is that you cannot incur only direct cost in making a product. There would be one or two elements of indirect cost in that company for that company to incur. So for indirect costs, we also have indirect material costs, we have indirect labor costs, and we have indirect expenses. So we may also buy materials, okay, that will not form part of the product. For example, we bought grease to grease our machine, just to make the machine, smoother maintenance. That is a material. But sir, if you check the bottled water, there's nothing like grease on the bottled water. There's no way you can find that grease was added to that bottled water. But during production, it is at the back end, there was grease that was added to the machine. So that will form indirect material. Ramiki says the person, the engineer that came to put that grease there just to make the machine move smoothly, the money we're going to pay him is an indirect labor. Machine did not break down, okay? We're just trying to maintain it, just trying to keep it float, okay? That's indirect labor. Then any other indirect expense that is being incurred. So indirect expenses, which relates to indirect material, indirect labor, the other indirect expenses. If you add all together, that is what ICAN calls overhead. So when you hear the word overhead, it simply means indirect expenses. Am I making sense? So all the direct costs added together is prime cost. All the indirect costs added together is overhead. So when you see overhead in your question, do not look morose and dejected. Overhead simply means indirect costs, whether it is material, labor, or expenses. They are all indirect costs. So these are terminologies. All right. Another terminology that you should know, okay, is we have other terminologies like sunk costs, okay, sunk costs. We have other terminology like historical costs, okay, historical costs. we have terminology like marginal cost, and we have terminology like absorption cost. So let me start from sunk and historical. Now, these guys are similar. In fact, another name for sunk in some short answer questions is actually historical cost. Another word for historical cost is also known as sunk. So these are costs that you have incurred in the past. Any money you have spent yesterday, 3 hours ago, 2 hours ago, in as much as you have spent it, they become historical cost, isn't it? So these are costs that you have incurred in either you have purchased something or you have produced something, they become costs, they become historical costs. Now, the reason why we call it sunk is because we have incurred it in the past and management decision cannot change it. Okay, management decision cannot change it. So let me give you an example. So I got beans 1 derica, okay, and I took it home that I want to cook beans. I've paid for the beans. That is sunk cost already. That's historical. That's past. When I got home, maybe my wife says, I don't want to eat beans. I think I want to take plantain and egg. And I say, if you want to take plantain and egg, me too, I want to take plantain and egg. No need for us to cook and keep beans. Would I be able to take that beans back to the seller and say, I don't want beans again? Take. Igbo man will not accept that. Nobody will even accept that, especially when it's an edible product, food. They won't accept that, except when you are saying, oh, I don't want these beans 1 derica, give me 2 derica. Hey, they can increase it to 2 derica. But say you don't want again, take, give me my money. No, that is a sunk cost. So whatever decision that managers wants to make, that cost that they have incurred cannot be changed. But suppose law, it has gone, it has gone. Just like a company say, they want to produce bottled water and they bought the machine already, invoice given, contract sealed and signed. The company now decided to say, okay, we are not producing bottled water again. We want to move into a new line of products. Sir, they can't return that thing, except if there was an agreement that states that you can return it. But on a normal ground, business ground, you cannot return it again. The person will not collect it. Money that has entered bank account has gone. So they can't take it again. So that becomes a sunk cost. Am I making sense now? That is historical cost. The other one is relevant costs. Okay, you're going to see more of relevant costs as we progress in this, because relevant cost itself is actually a topic on its own, relevant costing. So relevant costs, another name for it is more or less like saying future costs. Okay, so relevant costs, another name for it is future costs. So it simply means that these are costs that you will incur in the future because you have decided to make a decision. You guys have decided to do ICAN, and the cost you're going to incur in the future when you're calculating the money you're going to incur for ICAN is going to be your exam fee. You've not started paying exam fee, but trust me, maybe next 2 months, you start paying exam fee before November. So when you are now asked, how much are you going to incur for ICAN? That cost that you have not yet incurred, okay, for ICAN, which you will still incur, becomes what? Your relevant cost, your future cost. Am I making sense now? So these are costs that, okay, that will arise as a result of managers making a certain decision. So what is that decision? We want to do ICAN. So what is the cost you are going to incur in the future? The cost you're going to incur in the future is maybe lecture fee, okay, maybe examination fee. But if you have bought study packs or if you have bought past question, you cannot list past question as part of the cost, because past question, you have already paid for it. Past question becomes a sunk cost. But the ones you have not yet paid for that you will pay in the future as you proceed becomes your future cost or becomes your relevant cost. That is as simple as it is. There are a lot of terminologies in performance management that we cannot conclude in today's section. But I want you to understand that two of those terminologies are marginal costing and absorption costing. And that is why I'm taking this topic for today. Now, what is marginal cost? This is also another terminology. Now, another word for marginal cost is actually variable cost. Okay, another word for marginal cost is actually variable cost. Now, under marginal cost, according to an economics, means additional cost. Okay, if you're doing economics, marginal cost simply means additional cost. But in this context of accounting, marginal cost is variable cost, which also means additional cost in one sense, because variable costs are those costs that increases as what you want to produce also what increases. So when ICAN says calculate the marginal cost of this product, technically what ICAN is saying is calculate the variable cost of this product. Nobody should deceive you. It's as simple as that. Now, what does this mean? This means that you have to look at the question critically, okay? Then ask yourself, what are those things in the question that constitute costs? Because most of their questions we have cost, revenue, cost, revenue. So pick up those ones that are costs. Now, when they are cost, it simply means that they may either fall into fixed cost or variable cost. Only pick the ones that are variable first. Those ones that are variable are what we call the marginal cost. Am I making sense now? So marginal cost simply means variable cost. Now, let us move further. There's a difference between marginal cost and marginal costing. Marginal cost is the cost, which is the variable cost itself that you incurred in making the product or you spent in doing something. But marginal costing, for the word costing to be added to it, it is a technique. Okay, it is a technique. So just like saying that I call two ladies and say, please, can you cook? So sorry, I'll be using beans again. Can you cook beans for me? Then lady A says, yes, I can cook beans. Lady B also says, yes, I can cook beans. Then I said, okay, can you present me the ingredients you'll be needing for the beans? Okay, then lady A says, please just give me the beans, give me salt. I don't need Maggi. Okay, just give me beans, give me salt, give me pepper and oil, and I'm good to go. Lady B says, I usually put Maggi in my own, but 1 cube of Maggi. I can't cook my beans without sardine. You must give me also sardine to include in it. My pepper, don't give me ground pepper. You give me fresh pepper. What are you trying to insinuate from what I just said? Both of them are trying to achieve one thing, which is beans, but they all have different pattern of achieving it. While Lady One could cook with just 3 ingredients or 4 ingredients, Lady B could not cook with just 3 to 4 ingredients. She has her own spec, her own list of ingredients that she needs. That is a technique. Sometimes Lady A may say, okay, I will need to put pepper first before I put Maggi. This one will say, no, how will you put pepper first? You need to put crayfish first or onion first before this. So everybody has their technique. But at the end, they are going to arrive at what? Beans, making of beans. So the approach that you use to get something done is a technique. It's as simple as that. The approach you use to get something done is a technique. Am I making sense now? So when you talk about marginal costing, we can call it in full marginal costing technique. It means that is an approach that managers usually use in getting things done. What do you mean by getting things done? Maybe managers wants to prepare a profit and loss account. Okay, it's as simple as that. That is the best. That is one of the best that ICAN can come with. Prepare a profit and loss account using a marginal costing technique. So it simply means that they know that the profit and loss account, the final answer you're going to get is profit. But how do you get the profit? They want you to use the marginal costing technique. So it simply means that the marginal costing technique is an approach that can be used to determine your profit. Therefore, watch my screen. Okay. Therefore, what I can say using formula with regards to marginal costing is quite simple. So I can say marginal costing, if the manager intends to get profitability for a product or profitability for a company, it is going to be sales. You know, for you to get profit normally, sales minus cost. But if you say sales minus cost, this cost here will be debatable. You'll be asking yourself, is it fixed cost? Is it variable cost? So we need to make it very clear. It's going to be sales minus your variable costs. This variable cost simply means marginal cost. Why? Because you are asked to use marginal costing technique. So when ICAN says determine the cost of it, determine the profitability of this department, or determine the profitability of this product using marginal costing technique, the first thing you put in your solution is the sales, how much you sold that product. Okay, how much you sold that product, because you're trying to prepare the profit and loss account for your company. So how much did you sell the product that your company is selling? Then minus, don't minus cost, but specifically minus variable cost. The variable costs are those costs that changes, right? And it simply means that they include what? Your material cost, your labor cost, and your expenses. Jot this down. All direct costs are variable costs. That's the key. All direct costs are variable costs. So ICAN will not specifically say these are variable costs in the question. Once you see direct material, for a material to be direct, it means it's a variable cost. If you want to produce more of the product, buy more material. If you want to produce less of the product, buy lesser material. It's as simple as that. All direct costs are variable costs. So whenever we see direct material, take it out. Direct labor, take it out. Direct expenses, take it out. They are all variable costs. Then, once we are done deducting variable costs, the answer we are supposed to get is what we call contribution. Contribution. So sales minus variable cost is known as contribution. All right, it's known as contribution. So contribution is defined as simply the difference between sales and variable cost. So once we get contribution, we now focus on taking out our fixed costs. okay, before we now get our final answer, which we term as profits. It's as simple as this. Once you understand the flow of these formats that I've given to you, you should be able to solve a question that requires marginal costing. So when you are asked to prepare marginal costing statement or prepare a profit statement using marginal costing, get the sales, which is the revenue, and take out your variable cost, okay, variable cost, then you get your contribution, take out some fixed cost from your contribution, that gives you profit. Now, understand it at this level. There are one or two other points that I will need to tell you, but that is as we proceed in this topic. Okay, I'm going to say that when we start solving. Now, that is marginal costing technique. Now, what about absorption costing? Absorption costing is different from marginal costing. Now, marginal costing says that there's going to be separation between variable cost and fixed cost. Okay, but under absorption costing, there's not going to be any separation. There's not going to be any separation. It's going to be sales minus variable cost minus fixed cost. So we're going to say, okay, let me just do this here. Okay, let me just do this here. Okay, so under absorption costing, it is going to be absorption costing ACT technique. It's going to be sales, okay, sales minus, don't minus variable costs, all right? It's going to be minus what? Production costs. Production costs, all right? Now, this production cost, look at production costs critically, okay, production cost includes or is broken down into variable costs, okay, variable costs plus what? Fixed costs. Now, these are the things that you need to understand in performance management. These are the things you just need to understand first. So sales minus production costs. So in production cost means what are the costs that you incur in making the product? In making any typical product, even in Nigeria, in Pakistan, in Georgia, in the UK, to make any typical product, the producer must incur variable cost and must also incur fixed cost. When the producer adds the variable cost and the fixed cost together, it becomes production cost. So please note that variable costs can be incurred for production. Variable costs can also be incurred at the selling and distribution stage. Variable costs can also be incurred at the administrative level. But what we are focused here is just the variable cost and fixed cost incurred at the production level. ICAN will let you know, okay, ICAN will let you know that this variable cost was production cost, okay, or was administrative cost, or was selling and distribution cost. Whenever they are silent, it is treated as production. You're going to be solving the question that you're going to see the way I'm going to treat that transaction. You don't need to go anywhere. Stay with me. This is the introductory class. If you miss this out, law, is gone. Now, that is production cost. So sales minus production cost will give us profit directly. Okay, it will give us, let me specify that, it will give us gross profit. So once we get our gross profit, don't forget that the aim is to get net profit, okay, net profit. So when you get gross profit, you are not done. You have to take out your other costs, which are the costs you incur at the distribution level, selling level, and advertising level. Don't forget that we have treated production costs. So you are taking out other costs that are not production. So when you take out other costs that are not production, that will now give you your net profit. If somebody is jotting down, let the person jot down what I just did here, okay, for absorption costing, and let the person jot down what I did here for marginal costing. We're going to be using these two formats to dissect a complete question under marginal and absorption costing. If you are done with that, these are the points that you need to note. Now, let me explain these points for you. Now, sales minus variable cost under marginal costing. This variable cost simply means product costs. Product cost. Okay, product cost. Any costs you deduct from your sales directly is a direct cost. And all the direct costs are product costs. It's just common sense. Everybody here is good with financial accounting. So let me explain your profit and loss account that you usually prepare in your financial accounting. That profit and loss account that you have in your financial accounting will say revenue, Abi? After that, it will now say, forget about returning word, whatever. After revenue, it will now say less cost of sales. That less cost of sales, where you have your opening stock, purchases, closing stock, that everything under your less cost of sales, they are all product costs. If you don't know today, they are all product costs. These are the costs that you incurred in making the products. That is why we grouped all of them under cost of sales. Don't forget that after cost of sales, what do you not get? Gross profit. When you get gross profit, what do? You less every other expenses, electricity, power, salary. I did not speak cost, they are costs. But why didn't you include them in cost of sales? You didn't include them in cost of sales because they are not really direct costs. Okay, so any cost that you are taking out of sales directly becomes a product cost. That is the analysis. So variable cost in this respect is a product cost because it was directly deducted from sales to arrive at contribution. Now, fixed cost was not directly deducted from sales. It was taken out from contribution. That makes fixed cost a period cost. Period. Am I making sense? You can always reach out to me via the chat box, okay? PM is not complex. Just understand the rules and the rudiments that guides it. So for product costs, these are costs that are directly incurred in making the product, and they are taken out from sales directly as a direct cost away from sales. While your period costs are costs that we incur but are written off at the end of the accounting period. Okay. Now, so that is what we mean by the analysis that I gave to you here. That is under marginal costing. Now, come back to the big boy, absorption costing. For absorption costing, we said sales minus production cost. And inside the production cost, we mentioned that we have variable production cost and fixed production cost. Therefore, all the costs inside this production cost here becomes what? Period, product costs. Why? It means that because they were directly deducted from sales, they are what? Product cost. So both variable cost and fixed cost of production are treated as product cost in absorption costing. Whereas in marginal costing, variable cost is a product cost, while fixed cost is a period cost. This is the distinguishing factor. We don't need to talk too much. Let me give you two more points. Point number 2. If ICAN gives you a question, but tells you to solve using absorption costing and marginal costing, the final answer you're supposed to get is meant to be the same. So if you get 10 million naira under marginal costing as your net profit, you should be getting 10 million naira as profit in your absorption costing. This is not usually the case. There's an exception to the rule. What is the exception? When the question has opening stock, or when the question has closing stock, or when the question has the combination of both opening and closing stock, that means that the answers under absorption costing cannot be the same with the answers under marginal costing. It's as simple as that. I don't know if that makes sense. So please, ladies and gentlemen, be very careful. When you are solving a question under absorption and marginal costing, answers are meant to be the same. But if not, it simply means that either there was closing or opening stock in that question. I hope that makes sense. Okay, I hope that makes sense. All right, I understood this. Let's take a question. Let me show you how it is done. Okay, so you understand what we are going to do and how we're going to attack this. Now, forget about all this. Forget about all this. There's a terminology that I have not talked about, and that terminology is what we call over and under absorption. So I'm going to be explaining this as we solve our question. This is a very key terminology, and this is what fails students in the question. I'm going to be addressing this in detail. But let's come down to a question. This question is JADEC. Okay, let's solve this question. JADEC Limited. Now, when you have a calculation question like this, the first thing you need to do is come to the requirement and ask yourself, can I provide solution to this question? That's the first thing. You don't have enough time in your examination, or can I provide solution to this question? Be as it may, this question says prepare profit statement. The word profit statement simply means profit and loss account. No, nothing to, that's the name. Profit statement, profit and loss account. Now prepare a profit statement for the year ended 31st December 2008, based on, you see it now, using marginal costing. You now understand that marginal costing talks about sales minus variable cost, get contribution, take out your fixed cost, get your profit, right? Then the other one is absorption costing. Absorption costing simply means sales minus your production cost, which is both your variable production cost and your fixed production cost, isn't it? Then you get your gross profit. From your gross profit, you can now take out your other costs, okay, to get your net profit. All right, good. Now, looking at this question treats, is a little bit comprehensive. It's comprehensive anyways, and to address some things in relating to over and under absorption. Just what I just stated here, over and under absorption. So please stay with me closely. Now, let's read this question. Jadek Limited produces bottled wine. Bottled wine is their product. Okay? Bottled wine is their product. So the name of the bottled wine is called jarred wine. Okay? Which is bottled and sold in cases. So they make products, okay, called jarred wine, and it is bottled and sold in cases. No problem. Now pay attention. The normal annual level of production, let me explain what that means. The thing that they usually do in the company, the normal quantity that they usually produce in the company, that's what it means. So don't let grammar confuse you. The normal annual level of production, on a normal, we usually produce so quantity. Because before a company will operate in a particular year, they must produce a production statement, okay, or a manufacturing statement that shows how much they intend to make and to produce for that year. One of the reasons why they do this is because they want to budget for fixed costs. They want to know if the quantity that you are saying that we're going to produce is going to make us to incur an additional fixed cost, or the fixed cost that we're currently incurring can actually cater for it. It's as simple as that. So the normal annual level of production simply means the normal quantity that the company usually produces. Then I said on which the fixed production overhead absorption is based. So on which the fixed production overhead absorption is based is 80,000 cases. Don't let ICAN confuse you with grammar. This fixed production overhead absorption is based simply means on which the fixed cost determination is based. As I've said earlier, before any manufacturing company will commence operation for the next year, e.g. Dangote, the production manager would have sat down with every other team members. They would have drafted out the quantity that they want to produce. In this case, it is 80,000 cases. Am I making sense now? And the reason why they are doing this, or one of the reasons why they are trying to tell you the quantity that they're going to produce next year, is because they want to also tell you how much they are going to incur for fixed costs, which they call fixed production overhead absorption. Does that make sense now? So in simple terminology, the sentence, the normal annual level of production on which the fixed production overhead absorption is based is 80,000 cases, means that the normal quantity that we usually produce, and that is what we also use to determine what our fixed cost would be, is 80,000 cases. Is anybody confused? Please reach out to me via the chat box. Is anybody confused? I'm going to pause right here and give just 1 minute or two for question. If you know that your background is not noisy, ask any
question. Okay. Good evening, sir. Thank you so very much. Please, I would like you to explain again what's the interpretation of this fixed production overhead means. The way you explained it earlier, you related it with fixed costs. So I would like you to explain it again, sir. Thank you.
Okay, so thank you very much for that question. Fixed production overhead. I told you that whenever you hear the word overhead, it's an indirect cost. Okay? Production attached to it simply means this indirect cost was incurred during production. Fixed attached to it simply means that it does not change. So how much did we spend for fixed cost in the production department? It's what we call fixed production overhead. It's as simple as that. So Dangote asks the production manager, okay, how much will you incur as fixed cost for you to make this product? It's okay, 10 million naira. That's what we mean by fixed production overhead. Am I making sense now? Now, the word absorption here simply means to share or to apportion. Let me explain what that means. So when we say fixed production overhead absorbed, it simply means fixed cost shared. Am I making sense now? So this fixed production overhead absorption simply means the fixed cost that we incurred in the production department that we want to share on the 80,000 cases. Now, let me make it very simple for you, right? An example of fixed cost is let's say we usually spend 100K for fuel every month in our company. So fuel will become a fixed cost. Let's take that example as a fixed cost. So this fixed cost is used in the manufacturing department to produce our product every month, 100K, because we have lights. So 100K is fair for us to produce. Now, don't forget that whenever we own this bin, am I making sense now? We produce product A, we also produce product B, and we also produce product C. But we incurred 100,000 naira. This 100,000 naira that we incur is what we call fixed production overhead. That's what it means. Fixed production overhead, 100,000 naira. Now the question is, how much of this 100,000 naira is going to be paid by product A? Because you cannot carry the whole 100,000 and give to product A only. Product B we share, product C we share, because they were all produced during that time that we own the gen or that we bought the fuel. Therefore, how much of 100,000 will come to product A? How much of 100,000 will come to product B? How much of 100,000 will come to product C? Now, let's just share it arbitrarily. So let's say that this guy takes 400K. Okay, 400K. Let's say that this guy takes 300K. So I think we are left with how much? 300K, I mean. So let's say this guy also takes 300. Am I making sense now? Now, this 400K taken by product A is now what we call fixed production overhead absorbed, shared. Am I making sense now? So fixed production overhead absorbed. That is the fixed cost that we are taking as part of our own. That's what we mean by fixed production overhead absorbed. But the word fixed production overhead simply means the actual fixed cost that you incur. But once you have shared it to individual products, the portion that they've taken, instead of you to call it shared fixed cost, you can call it fixed production overhead absorbed. Another example can be we incur fixed cost of 1 million naira.
Sorry, sir. Excuse me, sir.
Please proceed. Ask your question. No time. I don't think she's there. Now, another example can be we spent 1 million naira as fixed cost and we produced 1 million units of bottled water.
Excuse me, sir.
How much is fixed cost? Hold on. How much is fixed cost per unit? If you spend 1 million
Sir,
naira,
sorry, I wasn't hearing you.
Hold on now. Hold on. If you spend 1 million naira, make a product, and you produce 1 million units, how much is fixed cost per unit? Fixed cost per unit is what? 1 naira. Does that make sense? That's 1 naira. This 1 naira means that for every product, we are going to be attaching 1 naira to each product. This 1 naira simply means fixed production overhead absorbed. Whenever you have shared your main fixed cost to individual or to a product or to a function or to anything, it becomes absorbed. Please ask your question. That's why I said use the chat box or raise up your hand so you will not confuse people that are already listening and jotting and you're trying to. So please ask your question. And the person that asked the first question, please, is that clear?
Yes, sir. It's very clear. Thank you so very much. Thank you.
All right. So the lady said, the lady is trying to ask a question, but she's not speaking. I don't know why. I don't know. Yes, please ask. Is it Okoroji?
Yes, sir.
Oh, yeah, talk now. You are the one, Abby.
Okay. Yes, sir. Good evening, sir.
Yes, sir. God bless
you.
you.
Good evening, everyone.
Yes,
okay. If I get you right now, from what you just explained, the 80,000 now in the case we are looking at is what will be shared among production and sales based on this question.
The 80,000 that you are seeing here is the quantity that we decided that we intend to produce next year.
Okay.
Based on
not what will be shared.
No, it is yes. Look at it. The 80,000 here is the quantity that we intend to produce next year, on the assumption that we are going to share our fixed cost based on this quantity. So let me just go for that. Hold on. Look at the fixed cost that was incurred in the question: 1,560,000. So 1,560,000 is the fixed cost that was incurred. If you decide to share it into individual products, you are going to share it based on 80,000 cases. That is what the question means.
Okay.
That's what the question means by the
Okay.
normal annual level of production on which, you see it now, the quantity on which we are sharing the fixed cost is what? Is 80,000 cases. So if we want to share our fixed cost, on what quantity are we sharing the fixed cost? It's on what? 80,000 cases. That is what that statement actually means. I don't know if that is clear now.
Yes, sir, it is.
I got disconnected. I wanted to ask a question concerning the fixed production overhead absorbed. What's the question? Madam, talk now. We have been waiting for you. You are the one delaying us. Is your background noisy?
Maybe her network is hanging or something. I don't know.
She's chatting from the chat box. She said she got it. Okay, that is why the record.
Hearing me. I wanted to ask concerning the.
Yes, I'm with you. Go ahead.
I wanted to ask concerning the fixed production overhead absorption, the 400K. I couldn't understand when you were trying to explain it, that it is now, because you said that it is now the shared one, but does that also mean that B and C is also fixed production overhead absorption?
Yes. B and C, that 300K is also fixed production overhead absorbed. Just add absorbed. Absorbed means what I collect, what they share to me. I don't know if you understand now. So anyone that they share to you is absorbed. If you are working in a company and they share petrol expenses, which is a fixed cost, if it's a fixed cost, if they share to your department, if I hear what you're supposed to say, say, oh, you're talking now. Yes, we can hear you talk. So please, I think your network is.
I was saying that means the 1.5 was shared among the three of them.
Where do you see 1.5? The 1,560,000. Is that what you're talking about? This 1,560,000.
1,560,000. Okay, okay.
This fixed cost is shared to each quantity, and the quantity we're going to be using is 80,000 units. So that's what it means. That's this 80,000 that we have here. So whenever we are sharing fixed cost of 1,560,000, we're going to divide it by how many quantity do we plan to produce? 80,000. So once you divide it, you're going to get your fixed production overhead absorbed, also known as fixed production costs per unit. That's what it means. Okay? Fixed production cost per unit. That's what it means. So I'm giving you guys time because I understand the fact that understanding the question is the first thing you need to understand or get before you start solving. So that's why I'm doing this now. So the annual level of production on which the fixed production overhead absorption is based is 80,000 cases, meaning that whenever we want to share our fixed cost, share it based on 80,000 cases. That's simple as that. So they now went further to say data for the last financial year ended 31st December 2008 were as follows. Now, what are the data? They said production, 90,000 cases. Sales, 75,000 cases. Remember, what you plan to produce is 80,000 cases. But now, what you actually produced is 90,000 cases. It happens, okay? It happens. Now, when you make the 90,000 cases, you were only able to sell 75,000 cases. Now, if you compare your production and your sales, it means that there's a closing stock. So this question has closing stock.
Yes.
So yes. 90,000 minus 75,000, that should give us 15, Abi?
Yes, 15.
So this 15,000 cases is our closing stock. We have spotted out our closing stock already from here. Remember what I told you? Yes. Whenever there's opening or there's closing stock in the question, the final answers can never be the same. So in this case, we already know that our final answer under marginal costing and our final answer under absorption costing cannot be the same. Where they are not the same, ICAN may request you to prepare a reconciliation statement. I will come to that. That is the most simplest thing in the whole world to prepare. We are coming to that. Now, after that, they now give us further information and say per cases in Naira. So to sell one case is 1,500. That's what we mean by sales. So let me just clean this. Let me clean this out. Okay. We're going to be doing this again. So let it become clear for you guys to see. So sales of one case is 1,500. Then what are the costs incurred? Okay. What are the costs incurred? They gave us cost direct material, 500 Naira for one case. This is it per case. Then direct labor, 400 Naira for one case. Variable overhead, 200 Naira for one case. Let me make sense now. All these are direct costs. I told you, all direct costs, all variable costs are direct costs. All direct costs are also what? Variable costs. Does that make sense now? So this direct material is a variable cost, which makes it what? A direct cost. This direct labor, okay, is a variable cost, which is what? Is a direct cost. This variable overhead, okay, is a variable cost, which is also a direct variable cost. It's as simple as that. There's nothing to argue. This is fine. Now the next one that says fixed production overhead. When you hear the word fixed production overhead, I've explained it before. This is the fixed cost you incurred during production. And in this case, it is 1,560,000. When you incur 1,560,000 as production cost, what comes to your head as the manager is, how do I share this cost to the individual products? Because who will pay for it? The products will pay for it. So you have to share it by product, okay, by the number of products you produced. But which quantity will you use? Should you use production quantity? Should you use sales quantity? Or should you use budgeted quantity? This 8,000 is also known as budgeted quantity. The answer is you will share it using what? Budgeted quantity first. Because the person has already told you from the beginning that the annual level of production on which it has told you from the beginning which the fixed production of our is being absorbed. The basis of sharing your fixed cost is using what? 80,000 cases, which is your budgeted cases. So there's nothing for you to do. So just make use of your 80,000 cases. In fact, in real life, that's what we do. In real life, that is what is obtainable. All right, the next one is variable selling and distribution cost. Now, variable selling and distribution cost, it is a variable cost, but this time it is incurred when we are selling and when we are distributing. Now, these ones are variable costs. I mean, these direct material, direct labor, variable overhead, they are all variable costs because I thought that all direct costs are variable costs, but they were incurred production. Even if they did not put production there, you should know that direct material is used in production department. Direct labor is used in production department. The variable overhead will be used in production department. So these three costs are incurred in the production department. But this variable selling and distribution cost was incurred when they were selling, meaning in the selling department and also in the distribution department. How much is it? They said 10% of sales revenue. So when we do 10% of sales revenue, we'll get our variable selling and distribution cost. Shikena. The final one is fixed selling and distribution cost. This is also a fixed cost, 150,000 naira, but it was not incurred in production. It was incurred when we are selling and when we are distributing. We don't need to share this one to individual products. What we are sharing to individual products is basically the one that we incurred when we are producing. So the fixed selling and distribution cost is we are going to just treat it as 150,000 rather than sharing it. It's as simple as that. Let me do a recap of what I have said. In this question, Jadek, they produce wine, and the wine is bottled in cases. Before the year began, they planned to produce 80,000 cases. And the manager said, look, these 80,000 cases, whenever we want to share fixed cost, that is what we should use in sharing fixed cost. No problem. Eventually, what did they produce? 90,000 cases. Eventually, what did they sell? 75,000 cases. That means that there's a difference of 15,000 known as closing stock. Chikena. The next part of the question says that, for us to sell one case is 1,500. And for us to produce it, we are going to spend direct material for one case is 500. Direct labor for one case is 400. Variable overhead for one case is 200 because this is already given to us per cases. Then that said, fixed production overhead is 1,560,000, which I told you that this is the fixed cost that we are going to incur during production. And I told you that when you incur this amount, you are going to share it. With which quantity are you going to use to share it? The budgeted quantity, which is 80,000. Very simple. Variable selling and distribution cost is 10% of sales revenue. This is also a variable cost, but it was not incurred at the production level. It was incurred at the selling and distribution level. Fixed selling and distribution cost, 150,000 naira. This is a fixed cost incurred at the selling and distribution level. We don't need to share it to individual products. We're just going to expense it during the period. You are required. Prepare a profit and loss account, aka profit statement, for the year ended 31st December 2008, based on marginal costing and based on absorption costing. You have just 1 minute. Ask me any question before I start solving. If you know that your background is very, very, very quiet, go ahead, please. Go ahead.
Excuse me, sir.
Yes.
Yes, sir. Okay. Now we were told that sales is 1,500 per
Yes.
per case.
Yes.
So sorry, I'm not trying to preempt you, but I just want to, align my thoughts with yours. So in this case, since we're told 80,000, that means we're going to multiply the 1.5 by the 80,000 to get our total actual sales.
Okay, no, we're going to do 1.5 times the quantity that we actually sold, 75,000 cases.
Oh, okay, 75. Okay, all right. Thank you, sir.
Sorry, sir. My question will be on the treatment of the variable selling and distribution costs. Since you said we are not going to share it, so are we going to do 10% of the sales and apply direct?
What I said we are not going to share is our fixed selling and distribution costs, 150,000. But for the variable selling and distribution costs, we'll do 10% of the sales value and we'll treat it as a variable cost, which I'm going to be doing in just a few minutes. But what we will not share is our fixed. Normally we are supposed to share fixed, but because this fixed is selling and distribution, we don't need to share it.
All right. Thank you, sir. Clear.
Interesting. It means that everybody is on point. Now, bam, let's go to the solution. All right. Can you see my screen? So I have my solution here. It's very simple. Now, the first thing you want to tell ICAN is the name of the company you're preparing your account for or the statement for, which is JADEC Limited, stated here. Let's go back to the question and see. This is JADEC Limited. So that's the first thing you want to tell ICAN. The next thing you want to tell ICAN is what you are preparing. In this case, we are preparing an operating statement, okay? And we are using marginal costing technique. So that's what I did here. Then after that, now the solution is. Now, because we're using marginal costing statement, I gave you a formula earlier where I said marginal costing, using marginal costing, we're going to say, okay, our selling price minus our variable cost equals to what? Contribution. They will take out our what? Our fixed costs. Get our what? Net profit.
Profits.
Are we good by that? So let's take the first guy.
Yes.
So the first guy is selling price or sales. Now, based on the question, okay, we sold 75,000 cases. And it will cost us, we sold one case for 1,500. It is crystal, very clear that 1.5 times 75,000 cases will give us the total sales revenue. Do you agree with me?
Yes, sir.
So let's go. 1.5 times 75,000 cases. That's what we did here. Let me zoom this so everybody can see clearly. Okay. So that's good. So sales, you will see it here as 1,500 naira for one case multiplied by 75,000 cases. If you are with me, you will get 112,500,000, 112.5. You get something like that?
Yes, confirmed.
Yes.
Perfect. So we are done with selling price. Somebody will now come and ask me, what about returning word? If they bring returning word in this question, it's not profit and loss account. They will not give you returning word though. I have not seen where ICAN will be giving you the returning word in PM. Okay, so sales will just be given to you as sales to compute. Then the next thing is going to be variable cost. Variable cost. Variable cost. Now, variable cost was given to us in the question. Let's go back to our question and check. We have direct material, which I say is a variable cost. Direct labor is a variable cost. This one is already variable overhead. It's a variable cost. We also have another variable cost here. Variable selling and distribution cost is a variable cost. So how many do we have? We have one, we have two, three, and we have four. But what is the distinguishing factors between these four? These 3 here we are incurred in production. Do you agree with me?
Yes.
But this last one was incurred in selling and distribution. Do you agree with me?
Selling and distribution.
After production.
Yes, sir.
Good. So I'm going to pick the one that we incur for production first. Okay. Direct material, direct labor, variable overhead. I will do Control-C in case you're using Excel in your exam. And I'll bring it here as Control-V. Direct material, direct labor, and variable overhead. Am I making sense? Are we together? How much do we spend? How much do we spend for these guys? We did 500, 400, 200. These are the cost per case. So I'll copy them to 500, 400, 200. I'll bring them and put them here too. 500 naira for one, 400 naira for one, and 200 naira for one. Now the question is, should I multiply this 500 naira times 75,000 cases that I sold, or should I multiply the 500 naira times 90,000 cases that I sold? I'm asking this question openly.
That I produce.
By what?
No, I'm trying to. You
Okay.
said by
Should I
90,000
multiply the
that you
production
produce.
cost by 75,000 or 90,000 cases? That's the question.
It's on 75,000 on sales.
On sales. Okay, somebody said on sale, which is 75,000 cases, right?
Yes, sir.
Yes, sir.
Yes.
Okay, is anybody countermanding that? Is there any other counter opinion? Is there any counter opinion? We are the ladies now. After they will say ladies first, ladies first, ladies first. All of them just mute. Ladies first.
No counter opinion, sir.
No counter opinion.
Yes, sir.
Do we have any financial reporter in the house? I'm a reporter, financial reporter in my company. Is the person here? No, I do. We are not yabbing you. Just identify yourself. We want to give you a job. No financial reporter. Okay, all of you are bookkeeper. Okay, no problem. Now, it's quite simple. Somebody said we should use 75,000 cases and multiply against this cost per unit. But the truth is that we are supposed to use 90,000.
Hello, sir.
We are supposed to use 90,000 cases. Yes, who is that? Somebody wants to speak?
Yes, sir. Yes, sir. I want to speak.
Okay, go ahead, please. Go ahead. We can't hear you. Okay, I think maybe you'll come back. So the truth is that we are supposed to use 90,000 cases. Why? When we were calculating sales, we use the sales quantity. Now that we are calculating production cost to make the product before we're able to sell, we are supposed to use our production quantity. Do you agree with me?
Okay.
Yes, I agree with you, sir.
God bless you.
Absolutely, sir.
So when this material, labor, variable cost, this is where the cost we incur to make the product, which is production. And the question says that we produced 90,000 cases. So we are supposed to use production quantity, 90,000 cases, to multiply this. But to my question, did I make mistake in the solution? I used 75,000 cases. Is this a mistake? What is this? What? It is not a mistake. Now, what did I do here? I said, okay, I know that I'm supposed to use 90,000 cases. Now, if I use 90,000 cases here to multiply, it simply means that I am going to get closing stock in this my solution. Because if I sold 75,000 and I produced 90,000, I'm supposed to say closing stock 15,000. Yes or no? Do you agree with me? I'm supposed to less closing stock 15,000. But seriously, I don't have time. I'm too busy. I'm too busy for ICAN to keep too busy as well. So what I did is that I decided to bypass closing stock. I decided to bypass the treatment of closing stock under this computation. So I told ICAN, okay, if my sales is 75,000, I'm also going to calculate my production cost based on 75,000 cash basis, or less by saying cash basis, actual. So that 75 that I produced, 75 that I sold, if you cancel each other, there's no closing stock. This is allowed in your computation. This is absolutely allowed in your computation. So I used 75,000 here. I did not use 90,000. If you are using 90,000 here, please note that you are going to account for closing stock. And I'm going to be doing that under absorption costing. So stay with me. When I get to absorption costing, I use 90,000 there. So I will tell you how I treated my closing stock. So in this case, I made life very simple by using 75,000. Please, can you still hear me? Am I still with you? Are you still with me? So let's go. 500,000 naira times 75,000 pieces that we sold. That should give you 37.5 if you can confirm that. The ladies, so yeah, confirm with us. So the people used to put calculator inside your everywhere in your body's calculator. Oh yeah.
Confirmed.
Thank you. Now
Confirmed.
for direct labor, we spend 400 naira. Multiplied by 75,000, you should get 30 million. You know,
Confirmed.
Thank you. 400 and 75,000, you get 15 million.
On point.
Thank you very much. These are the variable costs we incurred at the production level. Okay, don't forget that there's still one variable cost that we have not picked. Do you remember? Variable selling and distribution costs. Good. Now let's proceed.
Confirm. Yeah.
Yeah. If you add everything here, you get 82,500. If you add, good. Now subtract this variable cost of 82,500 from these sales. What do you get? You get 30,000.
30 million.
That is 30 million. Thank you. Now, normally, sales minus variable costs gives us contribution. But what I named is factory
Excuse me,
cost.
sir.
Are you with me?
Sir.
Hello, who is on the line?
Excuse me, sir.
Please go ahead.
Yeah, it's me, sir. Please, can you go back? You said if you add all this, it will give us what?
If you add 37,500, 30 million, 15 million, it must give you 82,500. Confirm, please.
Okay.
Thank you.
Okay.
Now take out 82,500
yes,
from 112,500. What do you have? God bless you.
30,000.
What did I call the 30?
Factory
Contribution.
You know why I added factory?
Because we've not added the selling and distribution.
God bless you. So I used the word factory here, telling my examiner, look, the variable cost that I have only deducted from my sales are only the variable cost incurred at the production, which is the same thing as factory.
At the production level.
God bless you. So now that I've gotten factory contribution, my brain will now say, don't forget the other variable cost. I'll say, no, I didn't forget. So I put it here, variable selling and distribution cost. So based on the question, they said variable selling and distribution cost is 10% of sales revenue. Can somebody do 10% of our sales revenue for us? You get 11,250.
Confirm.
Good. So when you take out this 11,250 from the 30,000, you will now get 18,750.
Contribution.
Yes,
Confirm.
That will not be our main contribution. Who is not in agreement? Now, somebody now asked me one day, I said, what about if I put my direct party, I did my direct labor, I did my variable overhead, and I still mistakenly did variable selling and distribution cost under it. Should I cancel it and begin to add up and do factory contribution, less this one again to get contribution? I said, no. What I did here is professionalism. Whenever you present your answers, the person that sees your answer knows that this person is Sabi. So, if the person sees the way I presented my answer, I got factory contribution. I adjusted my variable selling and distribution. Then I got the main contribution. The person knows that this person is exposed. If you mistakenly put your variable selling and distribution cost direct, it simply means that you are not going to get factory contribution again. Abi, you get contribution proper.
Yes.
Agree with me?
Yes.
Good. That is allowed.
Yes.
ICAN will allow it. There is no problem. So anyhow you want to solve it, this is PM. This is not IFRS that you have to follow a standard. Anyhow you want to go about it, but do it to the best of your knowledge. So contribution is what we have gotten. So we have gotten contribution here. Please, after contribution based on our formula, what's the next thing that we need to take out?
Other express. Other fixed production, right?
Fixed cost.
Other fixed.
Good. So what are the fixed costs that we have in the question now? We have two other fixed costs. What are the fixed costs that we have? We have this fixed production overhead, Abi.
Yes.
1,500,000.
Yes. And fixed selling.
And the fixed
selling and distribution.
150,000.
Cost.
So let's take it out. Let's take it there. So fixed production cost 1,560,000, and then fixed selling and distribution costs 150,000. If you add both, you get 1,710,000. Abi?
Yes.
Take it out from this guy. From
yes,
the 18,000. You get 17,040. You get it?
Yes.
So that is what we call your net profits.
So just a minute. Okay.
Confirm. Any question? We are done with marginal costing.
Just a minute, sir.
Any question? Okay, so we have one more guy to do justice to. And that guy is the absorption costing technique. If you are sleeping or you are dozing, I advise you with all my heart, go and wash your face. Absorption costing is not joking the way marginal costing is. When ICAN sets both of them, tend to rush to go and do marginal costing first. It is as simple as possible. You can manipulate whatever you want to manipulate. Just like as we have done, we escape the treatment of closing stock in a profit and loss account. But in absorption costing, no oracle. You cannot escape closing stock treatment. You must treat closing stock the way it is given to you. That is why if you look at my absorption cost, it is very long. It is longer in detail than the marginal costing. Also, in absorption costing, there's usually a treatment of over-absorption and under-absorption, which I'm going to be treating for you now. This is the bone in the throat of most professional accountants, which I'm going to be dissecting as we proceed now. Please stay with me. Now, let's move to the big dawn, which is the absorption costing. Now, for the operating statement using absorption costing, your sales remains your sales. Your sales does not change. 1,500 naira times 75,000 units. It is still 112,500. Agreed. Then I told you, okay, let me just put the formula here. Selling price minus what? Production what? Cost, Abi? To give you what? Gross, who still remember?
Gross profit.
Gross profit.
Then minus what? Other cost.
Other cost.
Cost to net profit.
Equals to net profits. Okay, so let's go. So our selling price has been done, which is the 112,500. Then we'll move to production cost. Remember I told you that production cost has both variable, Abi, and fixed in as long as you incur it in production. Do you remember? Variable and fixed in as much as you incur it in production. So let's go. What are the variable costs that we incur in production? This is your direct material, direct labor, variable overhead, everything that all in production. Copy them and paste them, the same thing. So direct material, direct labor, variable overhead. 500 naira, 400 naira, 200 naira, the same thing. The only difference is that we are not going to be multiplying by 75,000 now. We're going to be multiplying by 90,000 cases, so that we can get closing stock. Does that make sense now? Can we proceed?
Yes.
So if you multiply, do this one, 500 times 90,000, you get 45,000. 400 times 90,000, you get 36,000. 200 times 90,000, you get
45. Yes.
Confirmed?
Yes, sir.
Thank you. So we are done with these guys. Okay, we'll now pick the fixed costs. Don't forget, I told you that production cost is both variable costs. Let me put it away. Variable production costs plus what? Fixed production cost. So we have done the variable production cost. Now, which one is the fixed production cost in the question? Go back to the question. We only have two fixed costs here. We have this guy, fixed production cost, Abi, and we have this other fixed cost.
Yes.
Fixed service and distribution cost. Please, which one is fixed production cost? How much is it?
1,560.
1,560.
God bless you. 1,560,000. This is not per case.
Yes, sir.
Do you understand? This 1,560,000 is not
Is
per
in total.
Is the total.
Is in total.
So we need to break it down into per case and do our analysis. Now, please, this is the question. If we want to divide this thing now using number of cases, how many cases are we going to use to divide it?
80,000.
80,000.
80,000, your budgeted quantity. Come to my solution now. Calculator people, let's go. 1,560. Can I zoom this or can you see it clearly?
So that's it.
Good, sir.
It's okay like this? It's okay like this, Abi?
Yes.
Okay, a minute. Let me do it this way. So
Yeah, it's okay. It's okay.
Okay. So now let's go. 1,560, the total fixed cost that you incurred, Abi, divided by 80,000 cases. Can somebody do that for me?
19.5.
God bless you. Please look at my
19.5.
screen. Divided by 80,000 cases. So somebody said
19.5.
Who can tell me the meaning of this 19.5? Another word for it, a simple word for it.
Unit
Simple word for it.
Is the cost per case, sir?
Cost per what?
Per case.
No, not per case.
Per unit.
So
Per unit.
fixed cost per unit.
Per unit.
Yes, are you getting it now? So 19.5. So this is our fixed cost per unit. On the assumption that we are sharing using 80,000 cases. Does that make sense now? So 1,560 divided by 80,000 cases gives us 19.5. But we did not produce 80,000 cases. Yes, no. So we're going to say 19.5 times the 90,000 cases that we actually produced. That's why we multiply here with 90,000 cases. That should give you 1,755,000. Confirm for me.
Yes.
Why did you do that? Yes.
So what did you multiply? We lost your voice. What did you multiply?
80,000.
Okay, wait. There's a lot of noise. Let's mute first. Let's mute and let me do something for you. Let's mute, please. Thank you. Okay, so let's do it again. We spent 1,560,000 as our fixed cost when we assumed that we are going to produce 80,000 cases. So if you divide, it simply means that the fixed cost that we have been using for our calculation during the year is 19.5. Because eventually it is at the end of the year. And so you are going to know the total quantity that you have actually produced. As at the end of the year, we now realize that, what we actually produced is 90,000 cases. What do we need to do? All we just need to do is to say fixed cost per unit times 90,000 cases. Don't go and do 1,560,000 divided by 90,000 cases. You'll be totally wrong. So you do fixed cost per unit, which is 19.5 times what actually was produced, which is 30,000 cases. I don't know if that makes sense. It's more or less like you saying variable cost per unit, material times quantity that you produced, 90,000. So this is one. It's also fixed cost per unit multiplied by what? The number of cases that you produce, 90,000 cases. Does that make sense? Who is confused? Is anybody confused? Talk to me.
So can you explain that again? The rationale behind that. I'm trying to rationalize it.
Okay, it's simple. It's simple. It's operating like a variable cost. Let me give you an example. Let's use a practical example. Okay. Which product can we use now? Okay, fine. Very simple. Now, if my company, pay attention. If my company usually produces 10,000 units of products, watch you. Okay, 10,000 units of products. Or if my company usually spend 10,000, okay, 10,000 naira. Okay, and they usually produce 1,000 units. So this 10,000 naira is my variable cost, what they usually spend to produce. Watch you. This is what you usually spend to produce. And when you spend 10,000 naira, you usually produce 1,000 units. Please, 10,000 naira divided by 1,000, what will it give to us? 100, Abi? Is that not it? 10, Abi? 10. Hey, can they hear me? Is it my network?
Yes, sir. I can hear you, sir. Yes, sir.
Thank you. So my company spends 10,000 naira to produce calculator. And anytime I will spend 10,000 naira to produce calculator, we usually produce 1,000 calculator. Please, how much is cost per calculator? 10 naira. Do you agree with me?
Yes, sir.
Yes, sir. Yes,
now,
sir.
I'm asking you. Good. I'm asking you. How much will it cost the company to produce 2,000 calculators? Can anybody tell me?
You just multiply 10 naira by 2,000.
The same thing is happening here.
Since it will cost you 10 naira to produce one calculator, then you multiply with the 2,000 to get the actual.
Yes, now that's what we are doing here. So since I know my fixed cost per unit of 19.5, all I need to do is to start multiplying with any other quantity that I want to work.
Number of cases.
Okay. Do you agree with me now?
Yes, sir.
Yes, sir. Yes, sir.
So that's the logic.
Yes.
So that's
sir, that's under absorption.
Okay.
But you know, when you treated the margin at first, you use 75. Unlike here that you
when I treated
intend to produce
yes. When I treated marginal, I did not do anything.
Yes, sir.
I did not do anything to 1,560,000.
Yes.
I did not divide it. Why? Because
yes,
it's a period cost.
I
you understand?
Okay.
So you don't do anything to 150,000 because 1,560 because it's a period cost. All right, it's a period cost.
Period cost, okay.
Yes. But when we are doing
Yes.
absorption, how do you?
No,
When we are doing
no.
absorption, you need to divide. Please give me a minute, just 1 minute. All right. So are you still with me? So that's
Yes,
how
sir.
we got. So do it for me. So when we are doing this fees cost, 1,560,000, we don't need to divide by, we don't need to do all these things that we are doing. Why? Fees cost under marginal is a period cost. In a period cost, you don't need to divide the cost by quantity again. Okay? But when it is part of a product, meaning that you want to attach it to a product, you need to start dividing by quantity. So because this fixed production overhead is treated as a production cost, that's the reason why we are even doing all this divide and times. So it's simple logic. Divide your fixed cost by what you plan to produce, 80,000. Any answer you get multiplied by what you actually produce, 90,000. That's the logic. Okay? I think that is clear for everybody.
Okay, sir. Yes, sir.
So if that is okay, can somebody just add up everything here? You will get 107.55.
Confirmed.
Confirmed, sir.
Confirmed. All right. So cost of goods. When you add everything to give you cost of goods produced. Okay? Cost of goods what? Produced. Now, since this is cost of goods produced, when you get cost of goods produced, normally, what do? You take out closing stock, Abi. So, what's our closing stock in the question? Who can remind me? You produced 90,000, isn't it? And you sold 75,000. So, what's the closing stock?
15,000, sir.
15,000.
15,000.
So, for people that are saying, where are they even getting this figure from? We are not getting it from space. It's here. Production, 90,000. Sales, 75,000. The difference is 15,000. Closing. So let's do this now. That's how we have 15,000. Where is it? Where is it? So this is it. 90,000 minus 75,000. That's my workings. I got 15,000. Isn't it? 15,000 times 1,119.5. Oh, yeah, ask me, how do we get it? 1,119.5. How do we get it? Oh, yeah, now who is asking? Oh, you know it?
No.
Okay. It's not very simple. So let me tell you how I got this 119.5. So I did the workings here. Now the question is, this 15,000 we are talking about, it was not sold, Abby. So since it was not sold,
since
it was not sold, the question is, at what is the value of the closing stock? Have you all of you know stock valuation? Don't you do stock valuation? Inventory valuation. Let me put it that way. Inventory valuation.
Yes, sir, we did.
So what is the value of this 15,000 units of stock that was not sold? LIFO, FIFO, all those things that you did. So for us now, in this case, the value of this 15,000 naira and 50,000 quantity of goods not yet sold is 500 naira for direct material because direct material was used to make it. 400 naira for direct labor because direct labor was used to make it. 200 naira for variable overhead because variable overhead was used to make it. And 19.5. This 19.5, you already know how we got it now.
Yes, sir.
1,560 divided by 80,000, 19.5 per unit. Add all the per units together and multiply by the 15,000 quantity. You should get, look at the per unit here. Direct material 500, direct labor 400, variable overhead 200.
16,7925.
119.5, Abby.
Okay, you mean we should sum all together? Okay.
Yes, when you sum all together, you get 119.5.
Plus 400 plus 200 plus 19.5. Yes, sir.
Correct.
119.5.
119.5.
God bless you. So multiply by your 15,000. That will give you 16,792.5.
500. Yes, sir.
Confirmed.
Confirmed, Abby. Is there anyone confused among us all? Speak up.
Confirmed.
Is there anyone confused? Please kindly speak up. Any confused person here? Any person frustrated by PM? Any person being followed from the village?
Again, how you got the 119?
The 119, Abby? Sir, is it the 119? Network has taken that man out. I think I heard him. He said, how do we get the 1119.5? 15,000 is closing stock. And as an accountant, you need to ask yourself, how do we value this 15,000? What is the price we need to attach to it? Simple. Just add up all the units cost of making the product. We made the product with 500 naira material, 400 naira labor, 200 naira variable overhead. Then what do we get here? 19.5, which is the units for fixed production cost. Add all of them together. That will give you 1119.5. I did the workings here. Look at it. 500, 400, 200, 19.5, which is 1.560 divided by 80,000 cases. And that gave me this guy here, 119.5. So I used that 119.5 multiplied by 15,000 to give us 16,792.5. Is that clear now, please? Is that clear?
Yes.
So I've gotten that. Okay, that's fine. All right, that's fine.
Sorry,
Yes.
sir.
Proceed.
I don't know. This workings, will it be made available?
Yes,
This
yes,
is my first time off.
Yes, you get after this class.
Okay.
You get after this class.
Okay.
All right, so after taking out our closing stock, what do we get? Cost of goods sold. Isn't it 83,962.5? Do you agree with me? 100.5
Yes, sir.
minus this 83,962.5.
Minus
16.
Confirmed.
You agree now? So now, the next thing that we need to do is to
Yes, sir.
adjust for over or under absorption. Please note, normally, on a normal day, once we get to cost of goods sold, we're supposed to get to gross profit directly. Everybody knows now, sales minus cost of goods sold is gross profit, Abi?
Yes, sir.
Now, the reason why we are adjusting for over and under absorption is because the question provided for it. Please note, the question will not tell you directly that there's over absorption in this question. Neither will the question tell you that there's under absorption in this question. Do you agree with me? It will not tell you. It is not for you as the manager, as the accountant, to know whether there's over absorption or whether there is under absorption. I will give you the simple secret to know. The secret is whenever there's a difference between what you plan to produce and what you actually produce, it means that there's over absorption or under absorption in that question. Am I making sense?
Yes, sir.
Oh, you don't
Yes.
get it. Somebody did not get it. What we plan to produce is 80,000 cases.
Yes, sir.
Actually produce is 90,000 cases.
90,000 cases.
There's a difference, Abi.
Yes, sir.
That means that there's either over or under absorption in the question. Nothing you want to tell me. But when it is the same thing, there is nothing like over or under absorption. That is the rule. You get it now?
Yes, sir.
Okay, good. So let's do that now. So 90,000 minus 80,000. That's what I did here. 90,000 minus 80,000. We have 10,000. Multiply by 19.5. Multiply by this 19.5 that we did for fixed cost. We got 195.
Yes, 195.
195. Calm down. Let me explain this in total so you don't cram. You don't need to cram. So this is it now. Let me explain something to you. And two persons just hold calculator. Two good persons that can punch. Just hold calculator. Let's do this together. Now, we spent 1,560,000, Abi. Watch, let me do it down here. Let's do it down here. 1,560,000. Watch, divided by your 80,000 cases that we did before. And what do we get? 19.5. Abi?
0.5.
Thank you.
Yes, sir.
Then the other person, please do 1,560,000. Divide it by the 90,000 that you eventually produced.
17.333.
Sir, please.
17.333.
17.3.
Yes, sir.
Good. God bless you. Pay attention. During the financial year, January, February, March, April, May, June, July, you have been calculating 19.5 as your fixed cost per unit. Nobody queried you. Nobody queried you. Are you getting it now? But when we go to the end of the year, we now realize that this 80,000 unit is not the main one. What we actually produce is 90,000. You now recomputed, you now got 17.3. Am I making sense now? You now got 17.3.
Yes, sir.
It means that you have the fixed cost per unit has reduced. Yes or no? Fixed cost per
Yes,
unit
sir.
reduced. What has
Yes,
happened
sir.
here? What has happened here is equal to over absorption. So it simply means that over the years, over the months, you have been calculating 19.3, 19.3, 19.3. But at the end of the year, you now realize, I've been calculating a very high amount. To what I should have calculated is 17.3. It means that you have over. You have been over what?
Yeah.
Calculating.
Stated it.
Good. So replace this absorption with over what? Calculating. So it's the same thing. So when you hear the word over absorption, it means you have over calculated fixed costs. Does that make sense now? So before you're using 19.5, but you now realize that it's not supposed to be 19.5, it's supposed to be 17.5. So over the years, you have been over increasing your fixed cost, or you have been over computing your fixed cost. Does that make sense now? So that's what you mean by over absorption.
Yes, sir.
Good. So whenever there's over absorption, the rule is for you to minus. Whenever there's under absorption, the rule is for you to add for under absorption. Do you agree with me now? Is anybody
Yes,
confused?
sir.
No? Is anybody confused?
Yes, sir. Please, can you go over it again?
Okay, good. Good. Very simple. You incurred 1,560,000 as fixed cost, and you divided it by the 80,000 that you thought you were going to produce, what we call the budgeted quantity. And your fixed cost per unit is 90.5, meaning that when you were selling your products, you were selling your product having 19.5 as fixed cost inside of it. Yes or no? Do you agree with me?
Yes, sir.
Bob, thank you very much. As at the end of the year, you are now doing reconciliation. You now realize that, Oga, we did not produce 80,000. We actually produced 90,000. Okay? We actually produced 90,000. Now, do the fixed cost divided by 19,000. You will get 17.3, a lower value. You know that the higher you produce, fixed cost is supposed to drop now. If two people is sharing 100,000, it's not 50-50. If 3 persons is sharing, will it not drop?
Yes.
If 4 persons are sharing, will it not drop?
Mm-hmm.
Now. So now it is 90 product that is sharing this fixed cost. Therefore, fixed cost should drop to 17.3. So now that it has dropped, you have been increasing initially. You need to adjust for the difference. For us to adjust for the difference between 19.5 and 17.3, that's what we're trying to treat as over absorption. Does that make sense now? So over absorption simply means you have been over what?
Yes,
calculating your fixed cost during the year. So now let us calculate the difference. So now we are trying to account for the difference. Is the difference I want to account for? So what is the difference? 10,000, 90,000 you plan that you produce minus 80,000 that you want that eventually produce. That's 10,000. Then you multiply it by the 19.5 which you were using initially during the year to compute your fixed cost, which is your 19.5. This is 19.5 here. So once you calculate 19.5, you get 195,000. Is this clear now?
That's 195,000, sir.
God bless you. 195,000. Is anybody confused? Is anyone confused? Good. So
No,
whenever
sir.
you want to calculate or check for over or under absorption, the 2 things you just need to do is 1, check whether what you plan to produce is different from what you actually produce. If it's different, just know that there's over or under absorption. Look for the difference, 10,000. Then for you to know whether it is over or under, just do these small workings down in your notes. Okay? Calculate that fixed cost that you incur, divide it by the quantity that you projected to produce. Get a figure. That same fixed cost calculated by the quantity that you actually produce, get a figure. When the figure you get, okay, the last figure that you got is lower, it means that you have over budgeted. So this is the first thing you have been doing. This is the last thing this is doing reconciliation. It means that you have been over attaching fixed cost to the product at 19.5. It's supposed to be 17.5. That is over. You have been over calculating over the years. Am I making sense now? You have been over calculating. So that over calculating is what we call over absorption. And for over absorption, you minus. The rule is for you to minus. That is why we bracketed this word 195. We put it in brackets because it is over absorption. If it is plus, it means that it is under absorption. So now do 83,962.5 minus 195. You will get 83,767.5. Does that make sense now?
Yes.
God bless you. So now we can now take it out from our sales. So our sales minus this figure will now give us our gross profit. Is that clear? Check it out for me. 112,500. You get your gross profit. Once you get your gross profit, which is this point, what do you need to do again? Just move any other costs that you have not used in the question. So what are the costs that we have not used? We have not used fixed selling and distribution costs. And we have not used variable selling and distribution costs. Those are the two basic costs that we have not used in the question. So let's go and check it out. We've used our sales. We've used our direct material. We use direct labor. We've used variable overhead. We've also used our fixed production overhead, which is what we just did again. We have also used our variable selling and distribution costs. Have we? I don't think so. No, we've not used that. We've not used that. So our variable selling and distribution cost is not incurred in the factory. So we have not used that. Then our fixed selling and distribution cost, we have not used that. So this is the two that we have not used. Variable selling and distribution cost and fixed selling and distribution cost. So let's pick these two and use this in our solution. So for our fixed selling and distribution cost is 150,000. No need for you to divide with quantity because it's a period cost. Any cost after gross profit is a period cost. Period cost does not need you to start dividing with quantity. It is only product cost that you start dividing with quantity, multiply by quantity, doing all those quantity stuff. But period cost, back they don't multiply with quantity or divide by quantity. Put it like that. Therefore, variable selling and distribution cost, they said it is 10% of our revenue. Our revenue is 112,500. So do 10%, you get 112,500. Do you agree with me? Add both together.
Yes, sir.
You get 11,400. Okay. So take out the 11,400 from this guy. You get our net profit of 17,332.5. Is that clear? Is that clear? Did you get it? 28,732.5 minus 11,500. Is that clear?
Yes.
Good. So that's our net profit. So somebody said, assumption costing is more is more, what did he say? He said assumption costing is more detailed or something. It's more technical or complicated than marginal costing. Assumption costing is more technical, yes, than marginal costing. But more of what you'll be seeing going forward is marginal costing. So that does not mean that you should not know absorption costing. No. It is very, very simple if you understand the process. Know your sales, deduct your production costs, which are your direct material, direct labor, variable overhead. Once you come to fixed production overhead, which was given to you total, you have to divide it by the quantity that you plan to produce and multiply by the quantity that you actually produce. So that will give us your cost of goods produced. Once you get your cost of goods produced, take out your closing stock. How do you get your closing stock? What you produce minus what you sold will give you 15,000 closing stock. How do you value it? Use all the per unit that is above. Use all the per unit that is above. 500, 400, 200, then 19.5, which is 1,560,000 divided by 80,000, 19.5. If you add all together, that will give you 1,119.5 that we use there. So multiply it together, you get this. That's all. The other thing is to treat your over or under absorption. And I've taught you how to go about your over or under absorption. Okay? It's as simple as that. Now, the final answers we got, for our marginal costing, we got 17,040. For absorption, we got 17,332.5. This thing does not balance. It does not correlate. It may now require you to prepare what we call a reconciliation statement. Okay? ICAN may require you to prepare what we call a reconciliation statement. So these are our reconciliation statements. This is the solution here. Now, to prepare your reconciliation statement, you need your net profit and you need your closing stock. If the question asks opening stock, you also need your opening stock. But in this case, there is no opening stock in any of these questions. So what we only have is closing stock. So you need your net profit and you need your closing stock. Why do you need your net profit? Your net profit did not tally. That's why you need your net profit. Why do you need your closing stock? It is the closing stock that did not allow your net profits to tally. That is why you need your closing stock. And if there's any opening stock, your opening stock is also part of what did not allow your profits to tally. So that is what we're talking about. So what do we need to do? ACT, MCT. Whether you put MCT up and put ACT down, or you put ACT up and put MCT down, nobody sends you any message. Okay? Anyhow, we fly. Most times, many people usually put ACT up because ACT usually gives us the highest profits. So they usually put ACT up and put MCT down. Now, what is our net profit for MCT? MCT is marginal costing. What's our profit for MCT? 17,040, which is this. Do you agree with me? Then what's our net profit for absorption costing? 17,332.5, which is this.
2.5.
So minus it for me. Minus it for me. You get 292.5.
17.
Confirmed.
Confirmed. Good. Come to closing stock. Our MCT. What is our value for closing stock? 16,500. Remember, we did not solve closing stock in this, but it is easier for us to get closing stock. Our closing stock is actually 15,000 units, which is this, okay, which we have done here before. 90,000 that you produced minus 75,000 that you
under marginal or absorption.
It's the same thing. Your closing stock quantity is the same thing, does not change.
Okay. Yeah.
So it's 15,000.
15,000.
So there's the 15,000 that we have here. Okay. But at what price? At what price? The price is going to be 500, 400, and 200. That's the only thing that we're going to use. 500, 400, and 200. So that's what it is we are going to use. So 500 plus 400 plus 200 is what we are going to use. Do you understand? Direct material 500, direct labor 400,
yes,
variable by 200. These are the only variable costs that we incurred in production. Not like absorption costing that we incur direct material, direct labor, variable overhead, and fixed production overhead. In this case, there is no fixed production overhead. So if you add all these things together, what do you have? 500 plus 400 plus 200 multiplied by
16,500.
So this is 16,500. Then for ACT, we have already calculated ACT before. What's our closing stock? Look at our closing stock here. 16,792.5. 16,792.5. Look at it here. 16,792.5. Now, minus it, you must get 292.5. Do you get it? 292.5. You get it? 16,500 minus 16,792.5.
Confirmed.
Confirmed. That means we have prepared our reconciliation statement. For both answers to be correct, it simply means that closing stock was the reason why the net profit under marginal and absorption did not tally. Any question? Is that clear?
Yes, sir.
The net profit is what? Sorry, said the net profit is what?
Our answer is 292.5 under the difference is the same thing now. I said the reason why the answers are both the same is it shows that closing stock was the reason why our net profit under marginal and absorption was not the same. Do you agree with me?
Yes.
Yes, sir.
Question, sir.
Yes, go ahead. Thank you.
Sir, are we going to neglect the negative?
Yes, neglect the negative. Neglect the negative. I told you that you can put your absorption costing up and put your MCT down. Neglect the negative. Just leave it that way.
Okay, sir.
Mm-hmm.
Thank you, sir.
Any other question?
Sorry, sir. The second figure in that reconciliation, I can't get the figure. 16 what, sir? And how did we get it?
16,792.5.
I got the 16,500. I got that.
16,792.5.
Yeah.
We have already solved it here. Now look at the closing stock under absorption.
Okay.
16. Okay. Any question? Any question? Somebody is asking, where is the topic in somebody? Let me check that. He said, please, on that topic is in this. Oh my God. What topic is this under the study part? Marginal and absorption costing. What topic? Costing techniques. Go to costing techniques. You see it there.
Hello, sir.
Yes. Please, a minute. Sorry, a minute. Go here. Advanced costing technique. This 15%, you will see it there. Yes, madam, go ahead, Jerry. Sorry. Go ahead, madam.
Okay, sir. I didn't really get how you got that 16.5 in the MCT. I know we have
Okay.
it of 17,040. Then we totaled our direct labor, direct material, and overhead, which is 500, 400, and 200. So what did we now do again to get the next?
Multiply by the 15,000 units, your closing stock units, 15,000.
Okay, sir.
And that will give you 65. Are you there?
Sir,
Yes,
So,
sir.
oh yeah. Next question?
I've got.
sir, I wanted to ask if the under and over absorbed is the same to be the over and under budgeted. Because
Where did I write it? Where did I write that one?
no, you didn't write it there. But while I was like reading, while in school, they always say under over absorbed and under over budgeted for this absorption costing.
Under budgeted fees cost and over budgeted fees cost.
Yes.
Yes. Do you agree with me? That is it, yes.
Okay, sir.
I have questions, so if you are done with your own question, I have my own question before I will call it a day.
Hello, sir.
Yes, ask now because I will ask you my own.
How would you treat it in a reconciliation statement?
I didn't get you. What do you say? Please talk again.
I said, what if there was opening stock? How would you treat it?
Please, let's leave that for the next class. I have one question that has opening and closing stock, and it has two periods, period 1, period 2. So I'm going to be doing that in the next class, so we'll not bombard our head. So please stay with me in my next class, please.
Excuse me, sir.
Yes, proceed, sir.
Excuse me, sir.
Proceed.
Sir,
yes.
After closing stock, the 90 minus 75, which gives us 15.
Yes.
We multiply by 119.5, which gives us 1679. 2.5.
Yes.
Did you subtract it from the 100?
Which
yes,
100?
That's what you did. You subtracted from the
yes, from the
stock
100,
to get your cost of goods.
Yes. Yes.
Yeah.
Correct. Okay, I think that is that, Abby. So I have questions. Let me check who is still with me. Okay. So I have questions. Who can just give me two distinguishing factors between marginal and absorption costing? What makes marginal costing different from absorption costing based on what we have computed now? Please answer it professionally. Don't do professionally.
Yeah. Yes. Under absorption, we took cognizance of closing stock in our adjustment before getting our cost of goods sold for the period. But under marginal, we don't do that.
Do you mean we don't do that, or do you mean that we only bypassed it?
We bypassed it.
Okay. We bypassed it. Sorry.
I'm going to ask this question.
Yes, sir.
We bypass. Okay, another point.
Okay, I noticed that under marginal costing, we had a factory contribution, or we would say a main contribution. But under the absorption costing, we had a gross profit and then we had a net.
Excellent. There is nothing like contribution in absorption costing. I don't know how they want to do it, but it's not possible. There's never anything like contribution in absorption costing. You can only find contribution under marginal costing. Perfect. Excellent. Another one. I said two, but just give me more.
Okay, I observed that the net profit in marginal cost is higher than the net profit in assumption.
I
Sorry,
don't know
the
whether you are
net
Yoruba.
profit.
In absorption is higher than the net profit in marginal.
What profit the figure we have?
The net profit is higher than the one in the marginal. Is that what you're trying to say?
Assumption was higher than the net profit in marginal.
Correct. That's another point.
Yes.
It's always higher. Good. Now, why would the net profit of
Also,
marginal? Okay, go ahead.
okay,
Go ahead.
okay. Sorry, sir. Also, we in absorption, unlike marginal, the labor, direct material, variable overhead, and the fixed was taken into cognizance before, was adjusted before we arrive at our cost of goods sold. Unlike in marginal, where we get our direct labor, direct material, to get our factory overhead before adjusting for variable. I think that's another distinguishing factor.
So what you just said is that for marginal costing, variable cost is what we treat first. But for absorption costing, we treat both variable and production and fixed cost related to production. Thank you very much.
Thank you very much. Yes, sir. Yes, sir.
Then I want to ask one question. Okay, somebody wants to say something. Please go ahead.
Hello. Okay, I observe for marginal, we didn't consider the over and under absorption, but for absorption, over and under absorption was taken into consideration. That's for using our closing stock.
Perfectly well. There is nothing like under or over absorption under marginal costing. I have never seen it in all my years of lecturing this course. But you will see it, not always, but you will see it in absorption costing. Okay. Now, tell me, how do I know if there's over or under absorption in a question? That's it.
We'll look at the requirement, what we were asked to produce and what we produced.
Excellent. What you were asked to produce and what you actually
produce.
If they are different, Abby?
Yes, sir.
Perfect. Now, who can tell me, how do we know whether it is over or under?
Based on the sales unit.
Divide.
No.
It is over. It
is based on the budgeted production, sir.
Nope.
Nope.
Yes, that person.
We do the calculation of the total fixed cost over the number of budgeted one, as well as compare it with the fixed cost over the actually produced.
Okay, we are compared. Then how do we know if it is over or under? There's a statement that somebody wanted to make. That's the answer.
If what you have been,
if what we produced is more than what we budgeted.
God bless you.
Is over.
God bless you. If what you produce 90,000 cases is more than whatever you budgeted 80,000 cases, the answer is over absorption. Jot it down as you are looking at, as you are seeing that. If what you produce 90,000 cases, for example, is higher than what you plan to produce 80,000 cases, it means it is over absorption.
Now you call that 80,000 budgeted?
Yes, now that's budgeted quantity.
Yes, sir. Yes, that's the budgeted. So it's over absorption.
Then the reverse is the case for under absorption. Jot it down. Are you with me now? So I have another question.
Yes, sir.
If you are there, let me know.
Yes, sir.
I have another question. My other question is, Who can differentiate inventory valuation under marginal costing and inventory valuation under absorption costing professionally?
Okay, the difference is that under absorption, we took cognizance of all of them: direct material, direct labor, variable overhead, and fixed. But under marginal, we only recognize direct material, direct labor, and variable overhead.
Good. Use grammar for me. Use PM terminologies.
Good. Sakalaja.
Okay.
Sorry, sir, what's the question again, please?
Inventory valuation. How do we value inventory under marginal and absorption? Okay. Under marginal, we only use the variable overheads, that is the direct material, the direct labor, and the direct expenses. But under the absorption, it uses all, both direct material, both direct labor, both fixed production overhead, all of them. That's just the distribution.
You are still correct, but the terminology, you have not gotten the terminology.
Okay. Can we say under marginal costing, we use variable cost only, while under absorption, we use both variable cost and fixed cost?
Fixed cost.
You have not gotten the terminology. You have not gotten the terminology. So under marginal cost, we use variable production cost. I've said the answer already. I've said the answer.
That was what I actually wanted to say. Production.
Variable production cost.
So what did you say?
Under marginal, we make use of variable production cost. Because if you say we make use of variable cost, what about the
I said it now, so I said it.
You said variable cost.
Okay.
So it's not just variable cost, variable production cost.
Okay.
Oh yeah, use the terminology for us. For absorption. That woman, the lady that wants to speak. Oh yeah, tell us the answer for absorption.
For absorption will be total production cost.
Excellent. For absorption to be total production cost. Okay, so inventory is valued using what? Total production cost under absorption. That was why we added 542 and that 19.5. But when we are doing for marginal, we only use 54200. Look at it now. 500, 400, and 200, which were the variable production cost. Is this clear for everybody? Is it clear?
Sorry. I didn't get you, sir. Your voice was mute. Sorry.
My voice was mute, Ke. I said,
I guess network.
Inventory is valued under marginal costing using variable production cost only. Don't go and tell that variable cost, no. Tell them variable production cost, that is professional. Then absorption costing, inventory is valued using production costs. Is it now production cost, which includes your variable and your fixed production costs. Does that make sense? Does that make sense? Marginal cost and fixed production overhead are treated as period cost, while absorption cost and fixed production overhead are subtracted into the cost of product. Correct. All right. So if there's no any other question, do I have any other question? Okay. Which of these methods is being used for financial reporting purpose?
Absorption costing technique.
Absorption, sir. Absorption.
Correct.
Sir, please, you wanted to explain why the profit in absorption is higher than that of the marginal. You wanted to explain at some point.
Why the what?
I think the net profits in the absorption costing technique is higher than that of the marginal costing technique.
In many cases, it's always higher than the marginal costing technique.
Yeah, why, sir?
Okay. Now look at the makeup of the marginal. Look at the makeup of the. So what we would have done is this. Okay, this is what we'll do. In my next class, remind me, the question we are going to solve.
Okay, sir.
To solve both marginal and absorption using both the closing stock in both of them. So I'll be able to explain the makeup of both of them. So you see the reason why marginal is always reporting a higher profit than absorption is always reporting a higher profit than marginal costing. Are you
okay, sir?
So there's a question I want to solve. I think it's EMC Limited. It's a question that has 2 periods, opening and closing and opening stock. And I think it also has over and under absorption, something like that. So it's a robust question. So if we solve that one, that will cement our understanding, and I'll also explain the difference between both. The difference of why is higher than the other one. I think that is tomorrow now. I don't know.
Excuse me, sir.
They said PM for tomorrow.
Excuse me,
yes,
sir. Under this reconciliation statement,
yes,
under the net profit for marginal, the 1704. What was that in brackets? Is there 15 times what?
15,000 times 1,100. This 1,100 you got here.
Okay.
5 plus 4 plus 2. You understand?
The 5 plus 4 plus 2, okay.
Is 1,100, which is this. And this is your 15,000.
Yes, yeah.
You can question single-handedly. We are meeting either Saturday or Sunday again. So I will solve EMC, and that will be the end of marginal absorption costing. Then I'll move to a new topic. If you don't understand this one, to understand future topics may be difficult. Please take note of that. This is the bedrock. You must understand this one before you can understand future topics. I'll make the material available. Try your hand and solve this question again. Then I will solve one more question, which is EMC, opening, closing stock, and then it also has over, or I think either over or under absorption. And that will be the end of this topic. Ladies and gentlemen, my name remains Dr. President, and thank you for staying.